Hey everyone, welcome back to another deep dive. Sounds like we've got some growth-minded investors out there ready to explore some long-term options.
Absolutely, and we're diving into a great Motley Fool article today that compares two popular ETFs for just that purpose.
Yeah, the Invesco QQQ Trust, that's QQQ for those following along. And then there's the Vanguard S&P 500 Growth Index Fund ETF.
VOOG. Catchy.
Well, I guess they both are when you get used to them. But we're not just reading the article though, right? We're going to break it down and help everyone really understand these ETFs.
Exactly. We're going deeper, pulling out those key insights that are most relevant to you as an investor.
Okay, so let's set the stage. The article we're looking at is by David Jagielski, and he makes a case for growth stocks in general as the way to maximize gains over the long term.
Right. He's all about long-term potential. But of course, there's always some risk involved with the stock market, right?
And growth stocks, they can be kind of known for being a bit more volatile.
They're definitely known for being a bit more dynamic, let's say. You can see some bigger swings in the short term.
So you're saying they're a bit more of a roller coaster ride?
Maybe a bit. But the key takeaway here is if you're looking at a longer horizon, thinking decades down the road, the potential for growth stocks to outperform those steadier dividend stocks becomes much clearer.
Got it. Long game. I like it. So tell me more about these two ETFs, QQQ and VOOG. What makes them tick?
Well, QQQ, this one tracks the NASDAQ 100, so it's leaning heavily into tech, innovation, that kind of stuff.
Okay, so if you're a tech enthusiast,
It could be appealing. Then there's VOG. This one zeroes in on the growth-oriented companies within the S&P 500, so a little bit broader focus.
but both aiming for growth.
Right, and both have actually shown a pretty solid track record of beating the overall market over the past decade.
So they both sound like winners, but is there a clear front runner? Like, does one stand out?
Well, they've both done well, but when you look at it, QQQ's returns have actually been quite a bit higher.
Interesting. Higher returns. That sounds promising.
Yeah, you know the old saying, higher risk, higher reward.
I think I've heard that one before.
Well, it applies here. QQQ has a history of more dramatic swings, both up and down.
Ah, so it's not all smooth sailing.
Right. It's like a speedboat. You might get to your destination faster, but the ride could be a bit bumpier. VOG, on the other hand, is more like a cruise ship. A steadier journey, but it might take a bit longer to get there.
Okay, I love that analogy. It's really painting a clear picture. So are we talking about totally different companies in these two ETFs, or do they overlap at all?
There is some overlap. You'll find some of the same big players in both portfolios. Names like Apple, Nvidia, Microsoft, the usual suspects.
Yeah, those are the heavy hitters these days. But is there a difference in like how much of each ETF those companies represent?
There is, and that's actually a crucial point to consider. In QQQ, these tech giants make up about 26% of the total holdings, but in VOG, they take up a much larger chunk, closer to 35%.
Okay. So why is that difference in weighting so important? Does it really change things that much?
It does. It all boils down to diversification and your risk tolerance. Remember, QQQ has a tighter portfolio, only about 100 companies. VOG casts a wider net, over 230 companies.
Right. So QQQ is putting more eggs in fewer baskets.
Exactly. So its fate is a bit more closely tied to the performance of those select companies, which can lead to bigger swings, both positive and negative. VOG, with its wider spread, offers greater diversification and potentially a smoother ride.
Got it. So QQQ is a bit more of a gamble, potentially higher gains, but also a bit riskier, while VOG is a bit more steady, a safer bet. Is that a fair assessment?
I think that's a pretty good way to put it. But before we decide which ETF is better, we need to consider the bigger picture. What happens if the market takes a breather?
Well, hold on. I thought we were talking long-term growth. What do you mean by takes a breather?
Well, you know, the market doesn't just go up forever. It goes up, it goes down, it fluctuates.
Yeah, the roller coaster, I'm starting to get it.
Exactly. So we need to think about what happens to these ETFs if things cool down a bit.
Okay, fair enough. So play it out for me. What happens if things go south?
Well, if we see a slowdown, VOOG's diversification strategy could actually offer a little more protection, like a cushion during those market swings.
Okay, so diversification might help soften the blow. Makes
Yeah.
sense. But what about QQQ in a downturn? Wouldn't its concentrated approach make it more vulnerable?
It's possible, but remember those tech giants that make up a smaller percentage of QQQ's portfolio. If those big names like Apple take a hit because of high valuations, QQQ might not be as affected, since it's less reliant on their individual performance.
Ah, so it's a balancing act. Diversification versus the potential for individual companies to outperform.
You got it. And that's what makes investing so interesting. There's no one-size-fits-all answer. It really comes down to your individual comfort level with risk. Do you prefer a smoother, more diversified journey, or are you willing to ride the waves for potentially bigger gains?
All right, so we've got QQQ, the potential high growth, potentially higher risk option, and VOAG, the steady diversified choice.
Think of it this way. You're choosing between a speedboat and a cruise ship. The speedboat might get you there faster, but the ride could be a bit bumpy. The cruise ship offers a smoother journey, but might take a little bit longer. Both will get you to your destination, just different experiences along the way.
Love that analogy.
Yeah.
It really helps to visualize it. So what does the Motley Fool article say about all this? Which one do they think is better?
Well, the author David Jagielski, he admits he personally prefers QQQ.
He's a speedboat guy.
You could say that, but he's quick to point out that his preference isn't necessarily the right fit for everyone.
Makes sense. Investing is personal, right?
Yeah.
What works for one person might not work for another.
Exactly. There's no single right answer. What matters is finding the investment that aligns with your individual goals and risk tolerance.
And that's exactly why we're doing this deep dive. We're going beyond just summarizing the article, giving you the tools to evaluate these ETFs and make informed decisions for your specific situation. But before we go any further, let's take a closer look at some of the nitty-gritty details about these ETFs that you'll need to consider when making your choice.
So we've talked about tech being a big factor for both QQQ and VOOG, but it's worth pointing out that QQQ goes even deeper into that world.
Oh, how so?
Well, take a look at their allocation. About 60% of QQQ's portfolio is dedicated to those innovative tech companies.
50%, that's a big chunk.
It is. Now, VOOG also has a considerable stake in tech, but it's not quite as heavily invested, under 50% for them.
So if I'm really bullish on tech, like I think it's just going to keep booming,
Yeah.
QQQ seems like the more appealing option, right?
It could be. But it's worth remembering that while tech is exciting and full of potential, it's also known for being, well, a little unpredictable at times.
Yeah. What's hot today might be old news tomorrow.
Exactly. Things change so fast in that world. And because QQQ has such a high concentration in tech, it's naturally going to be more sensitive to any ups and downs in that sector.
Right. So higher potential gains,
Yeah.
but also the possibility of bigger drops if the tech sector takes a hit.
Exactly. It always comes back to risk tolerance, doesn't it?
Seems like it's the theme of today's deep dive.
It's the theme of any smart investment strategy. So let's say you are comfortable with a bit more risk and you're a big believer in the power of tech. Does that automatically make QQQ the best choice? Well, if you're thinking long-term and really believe in the potential of tech, QQQ's narrower focus with that higher growth potential might align really well with your investment style. But if you're someone who's a little more cautious, prioritizing steady growth with less volatility, VOOG and its broader diversification might be a more comfortable fit.
So QQQ is for the investor who's okay with a bit of a gamble, and VOG is more for the steady-as-she-goes type.
You could say that,
Yeah.
but it's not just about the companies in the portfolio. We also need to consider things like the expense ratio.
Expense ratio. Remind me what that is again?
It's basically the annual fee you're paying to have your money managed within an ETF.
Oh, right. Like a management fee.
Exactly. Now, QQQ has a slightly higher expense ratio, around 0.20%. VOG's is a bit lower, about 0.10%.
Okay, so just 0.1% difference. That doesn't seem like a huge deal breaker.
You're right, it might not seem like much on the surface, but remember, we're thinking long-term here. Over time, those seemingly small percentages can add up and eat into your overall returns.
Yeah, compound interest can work both ways, I guess.
Exactly. So even if QQQ has a slightly higher potential for growth, that higher expense ratio could end up impacting your net gains in the long run.
So it's a balancing act, isn't it? Weighing the potential for higher returns against the cost of getting those returns.
Precisely. It's about understanding these nuances and making informed decisions that are right for you.
Okay, so to recap, QQQ is our focused growth sprinter with potentially higher rewards but also higher risks. And VOG is our diversified marathon runner, offering more stability but a slightly slower pace. Both can get you to the finish line, just with different approaches and pacing.
A perfect analogy.
I'm getting good at this.
Well done. But remember, there's no one right answer. It's about finding the strategy that best suits your needs and preferences.
Okay, so let's circle back to the Motley Fool article for a second. They're known for giving investment advice, right?
They do. They offer lots of resources for investors of all levels.
So they're a pretty credible source, I'd say.
Yes, their articles often provide valuable insights and analysis. It can be a great starting point for research.
Right, but it's important to...
Do your own research.
Exactly.
Always.
You've got to explore different perspectives. Remember, no single source has all the answers. So we've got some good insights from the Motley Fool, but always good to keep in mind this is just one piece of the puzzle.
Exactly. Now let's switch gears a little. We talked about what happens if the market slows down, but what if we have the opposite? What if things keep heating up?
Oh, a booming market. Now that would be a fun problem to have.
Right. But seriously, how would these ETFs be affected in a super strong market?
Oh, I guess both would benefit, right?
Most likely, yes. Riding that wave of positive sentiment. But QQQ, with its concentrated growth strategy, might have the potential to outperform VOOG in that scenario.
So even in a thriving market, there are nuances to consider. It's not as simple as just picking an ETF and hoping for the best.
Exactly. You've got to understand those underlying dynamics, make those informed decisions. And that means considering those external factors that could have an impact, things like interest rates, for example.
Whoa, interest rates. Okay, I know I've heard that term thrown around, but I've never really understood what it means for investors like me.
Well, imagine interest rates as the cost of borrowing money.
Okay, the cost of borrowing money, got it.
When those rates rise, borrowing becomes more expensive for businesses. And that can impact companies' ability to, invest and grow, which could slow down economic growth and affect the performance of these companies within our ETF.
So higher interest rates, not so good for growth stocks.
It's definitely something to watch out for. Lower interest rates can be good because borrowing becomes cheaper, but when those rates climb, it can make things a bit tougher.
Wow. It really is all connected, isn't it? It's not just about looking at individual companies or ETFs in a bubble.
Right. Everything's linked. And speaking of connections, let's not forget about technology. We've talked about how important tech is to these ETFs, but tech is always evolving, always disrupting industries.
Yeah, the tech landscape, 5-10 years from now, who knows what it'll look like?
Exactly. So it's crucial for investors to keep an eye on these emerging technologies. How are the companies within these ETFs adapting? Are they embracing these new trends?
So even if we become experts on QQQ and VOOG and the market is doing great, there's still that element of uncertainty. Always got to be ready for those curveballs.
It's like a game of chess. You got to be thinking a few moves ahead, anticipating those changes.
Okay, well, that sounds a bit intimidating, but also exciting.
That's the spirit. Investing is dynamic. It keeps things interesting.
Well said. Okay, I think we've covered a lot of ground today. We've compared QQQ and VOOG, looking at their potential benefits and risks, talked about interest rates, technology, all these things that can impact investments, and of course, emphasize the importance of knowing your own risk tolerance, doing your research, and staying informed. But before we move on to the final part of our deep dive, I want to leave our listeners with something to think about. How can you take everything we've talked about today and apply it to your own investing journey?
That's the million-dollar question, isn't it?
So much to think about. It really is a mental workout, this whole investing thing.
It keeps you on your toes, that's for sure. But it's worth the effort.
Absolutely. Okay, before we totally lose sight of our main event, let's bring it back to those two ETFs we've been dissecting, QQQ and VOOG.
Right. We've explored the market. We've talked about all the factors that play a role. Now it's decision time.
Okay, final round. Face off. Knowing everything we've learned, what are the key takeaways when it comes to actually making that choice between QQQ and VOOG?
All right, let's recap. QQQ, it's tracking the NASDAQ 100, so it's offering you a more concentrated bet on technology and innovation.
It's a heck heavy hitter.
Exactly. And that tighter focus, that smaller pool of companies, it can mean bigger potential returns. But of course, as we've discussed, it also means greater volatility.
Higher highs, lower lows.
Right. So if you're really bullish on tech, you really believe in its long-term potential, and you're comfortable with a bit of a roller coaster ride, well, QQQ might be a good fit.
Okay, QQQ for the thrill seekers.
In a sense, yes. But remember, investing shouldn't be about seeking thrills. It's about making calculated, informed decisions.
Of course, of course. So what about VOG? What's the story there?
VOOG, it's following the growth-focused companies within the S&P 500. So it's giving you a more diversified approach, spreading your investment across different sectors that can provide more stability, potentially soften those blows during market downturns.
So for the investor who prefers a smoother ride.
Exactly. Now, remember, diversification might mean you don't capture the full upside of a tech-driven boom, for example.
Right. Trade-offs. It always comes back to that.
It does. And that's why understanding your own risk tolerance is so crucial. There's no right or wrong answer here. It's about finding the best fit for you.
Okay, so we've got QQQ, the focused growth, potentially higher reward but also higher risk. And VOOG, the diversified stability, may be a bit slower growth but a smoother journey.
You got it. And remember, choosing the ETF is just the first step. Investing is an ongoing process. You have to stay informed.
Right. It's not like you just set it and forget it.
Exactly. You have to stay engaged, keep learning about the market, about those economic indicators, those hidden currents we talked about.
Yeah, like those interest rates.
Exactly. The more you know, the more empowered you'll be to make those smart decisions.
Well, this has been a fantastic overview. I feel like we've gone from 0 to 60 in the world of growth stocks and ETFs. And I definitely feel more confident, more informed about how to approach these investment decisions.
That's what we like to hear. Knowledge is power.
Absolutely. But before we wrap up completely, I want to leave our listeners with a final thought, something to chew on as they continue their investing journey. We've talked about choosing between QQQ and VOOG, but let's zoom out even further. How do these ETFs fit into your overall investment strategy?
Great question. These ETFs are just two pieces of a much bigger puzzle, right? Think about how they complement your other investments.
Right, your overall portfolio.
Exactly. It's about balance, diversification, aligning your investments with your personal goals and your timeline.
So much great advice packed into this deep dive.
Well, we try our best.
You've done a fantastic job. I'm feeling inspired and ready to take action. But it's clear, investing is an ongoing journey.
It is. Always more to learn and discover.
Absolutely. Well, on that note, I think it's time to wrap things up. Thanks for joining us on this deep dive into the world of growth stocks and ETFs. We hope you've learned a lot and feel ready to take control of your financial future.
Until next time, happy investing.